Good morning, I'm Maiki Oreta and you're watching Business 360, where we break down the numbers, connect the dots, and give you the developments and the insights you need to navigate, adapt, and lead. Let's dive right in. President Trump slaps 25% tariffs on Japan and South Korea and sends trade warning letters to a dozen other countries. Philippine debt hits a new record, nearly 17 trillion pesos, but Malacañang says it's all still under control. And later on in the show, we sit down with Joanna Ongpin Duarte of Alphaland to talk legacy, luxury, and where the publicly listed leisure giant is headed next. Now, the trade war just got bigger. The U.S. is slapping 25% tariffs on all imports from Japan and South Korea starting August 1st. President Donald Trump posted copies of his letters to both countries' leaders, warning that more nations are next. The White House says 12 other countries, including Indonesia, Bangladesh, Serbia, Cambodia, and Thailand, will be hit with duties of up to 40%. Trump also signed an executive order extending the July 9 deadline to finalize trade deals. The new deadline, August 1st. For the Philippines, this escalation puts the region on edge. Local exporters, outsourcing firms, and investors now face new uncertainty as supply chains and trade routes come under fire.
The reciprocal tariff rate or these new rates that will be provided in this correspondence to these foreign leaders will be going out the door within the next month, or deals will be made. And those countries continue to negotiate with the United States. We've seen a lot of positive developments in the right direction, but the administration, the president, and his trade team want to cut the best deals for the American people and the American worker. That's what they're focused on.
Global markets are on edge after a fresh wave of U.S. tariffs and a political bombshell from Elon Musk. Wall Street closed lower Monday as President Trump unveiled new tariffs on Japan, South Korea, Malaysia, South Africa, and 4 other nations. Adding to the turbulence, Tesla stock took a hit after CEO Elon Musk, formerly Trump's first buddy, announced he's forming a third political party.
Stocks are lower here today, coming off some all-time highs, in particular because of the trade and tariff headlines that popped up over the weekend and this morning. So we've got some actual numbers put on trade partners, big trade partners, and then the threat of additional tariffs. You know, we kicked the can down the road a little bit from July 9th to August 1st, but not a lot, still not a lot of time to make trade deals with 50 plus countries.
All 3 major gauges on Wall Street were in the red. The Dow Jones Industrial Average lower by 0.9%, the S&P 500 lower by 0.8%, and the tech-heavy Nasdaq lower by 0.9%. Over in Europe, it was a mixed session. London's FTSE dipped 0.2%, Germany's DAX surged 1.2%, and France's CAC 40 added 0.4%. Here at home, our debt hit a new record, nearly 17 trillion pesos, but Malacañang says there's no need to sound the alarm just yet. Outstanding debt climbed to 16.92 trillion pesos as of end May, the highest on record as the government continues to fund its spending agenda. Malacañang insists the situation remains stable. Press Officer Claire Castro notes that the debt-to-GDP ratio is still below the 70% warning line monitored by global agencies. She emphasizes that the borrowing is strategic, channeled into long-term priorities like infrastructure, education, agriculture, and public health. On another front, the country's financial watchdogs are on alert as geopolitical shockwaves continue to rattle global markets. Financial Stability Council Chair and BSP Governor Eli Remolona say that they're working closely with key agencies to safeguard market confidence and keep the system stable. In its latest stability report, the FSCC warns that while the Philippine financial system remains resilient, moderate risks are brewing. Those risks include escalating global conflict and sudden policy shifts under U.S. President Donald Trump. Now, on another front, with online gambling under fresh fire, Malacañang is signaling a more measured approach. President Ferdinand Marcos Jr. is open to taxing and regulating online gambling rather than banning it outright, as lawmakers and religious leaders sound the alarm on its growing social costs. The palace says the president is reviewing the finance department's proposal to impose a gambling tax aimed at generating revenue while curbing addictive use. Press Officer Claire Castro stresses the president wants data-driven policy, one that considers not just the economic gains, but also the potential harm to Filipino families. She says Marcos isn't ruling out restrictions, but believes the better strategy may be smart, targeted regulation. Several bills have been filed in Congress, either tax or ban gambling. The stage is now set for a national debate on where to draw the line between freedom, revenue, and public harm. Now, a new bill backed by the Department of Agriculture could shake up who controls the rice market and how Filipinos buy their most basic staple. The Rice Industry and Consumer Empowerment Act, or RICE Act, seeks to restore the National Food Authority's power to sell rice directly and accredit retail outlets. Under the current rice tariffication law, the NFA's role is limited to holding a 15-day emergency buffer stock. The bill would change that, letting the agency bypass local governments and middlemen to release stocks straight to the public. It would also set a floor price for palay, protecting farmers from rock-bottom prices that have dropped to just 7 pesos per kilo in some areas. If passed, the RICE Act could rewire a market that has seen both price volatility and supply strains, putting the NFA back in the driver's seat. And from grain to graft, the fight for economic justice continues. President Bongbong Marcos is throwing his support behind a bill to strip bank secrecy for public officials in a bid to boost transparency and crack down on corruption. The proposal, refiled by Senate President Chis Escudero, would force government officials to waive bank secrecy, making it easier to trace ill-gotten wealth and hold officials accountable. Escudero argues that the law, originally designed to protect savers and promote investment, has morphed into a shield for money laundering and tax evasion. Only those in honorary or non-salaried positions would be exempt. He adds that the Philippines is now the last country in the world to enforce absolute bank secrecy, a policy that, in his words, protects corruption, not democracy. Now, the Philippines is fast becoming a cashless economy, signaling a major shift in consumer behavior and digital financial inclusion. New data from the Bangko Sentral ng Pilipinas shows 57.4% of monthly retail transactions are now done digitally, surpassing this year's target under the Philippine Development Plan. Digital payments also account for 59% of total retail transaction value, a sign that more Filipinos are embracing convenience, speed, and safety in everyday spending. BSP Governor Eli Remolona Jr. says that this isn't just about tech, it's about building a more inclusive financial system that brings every Filipino into the formal economy. Now, Philippine unemployment eases in May, a sign that the labor market is holding steady despite global uncertainty. Data from the Philippine Statistics Authority shows that the jobless rate dropped to 3.9% in May, slightly better than April's 4.1% and lower than the same period last year. That's equivalent to 2.02 million unemployed Filipinos. The services sector remains the biggest job driver, accounting for nearly 62% of total employment. We're taking a quick break. Please stay with us as we dive deep into the numbers and the narratives that matter most to your bottom line. Welcome back. Let's check on how Asian markets are doing this Tuesday morning, with investors watching for new data and geopolitical signals. Right now, I'm seeing a sea of green. The Nikkei 225 is up by a little less than 0.1%. Hong Kong's Hang Seng Index higher by 0.4%, Shanghai's Composite up by 0.2%, and Singapore's Straits Times Index up by 0.1%. So we're seeing marginal gains across Asia. Here at home, Philippine shares kicked off the trading week in the green, riding on tame inflation, rate cut buzz, and a breather from Trump's tariff deadline. The PSE index climbed 0.5% to close at 64.25. On Monday, this boosted by dovish sentiment toward the BSP and a U.S. deadline extension. Now, value turnover hit 7.8 billion on over 910 million shares traded. Foreign investors turned net buyers, bringing in 107 million pesos. Analysts cite softer June inflation and rising odds of a BSP rate cut ahead of the Fed. Rollbacks in fuel prices and the passage of SEMEPA tax reforms are also adding liquidity and lifting investor sentiment. Now, top traded stock Digi Plus Interactive surged nearly 15% to 33.80, bouncing back even as lawmakers intensify scrutiny on online gaming. All eyes now are on today's employment and industrial output data as investors are cautious ahead of Trump's August 1 tariff deadline. Now, taking a look at the PSE index as of 10:17 this morning, the main gauge is flat with a slight downward bias. All shares index is also flat with a slight downward bias. The financials, industrial, holding firms, and mining and oil counters are bucking the market's current downtrend. Volume is at 86 million shares, valued at a little under 1 billion pesos. Now, market breadth is positive. However, we've got 73 advancers, 50 decliners, and 51 stocks unchanged. Taking a look at our currency market, the peso opened stronger at 56.55 from the dollar, up from the previous close of 56.69. Now, is the Philippines headed for a credit crunch? A new report says credit card debt has reached critical risk levels, with Filipinos owing up to 425% of their monthly income. Sujin Kim has the details.
A new warning from Singapore-based fintech firm Roshi Pte Limited has put the Philippines in the spotlight, raising the alarm that the country's credit card debt has reached critical risk levels. According to the report, the Philippines tops all 12 countries in the region, with the average Filipino cardholder owing 425% of their monthly income. A level that indicates, they say, severe financial stress. Roshi warns that debt of this magnitude can easily set off a chain reaction, missed payments, ballooning interest, and eventually default. The Philippines' debt-to-income ratio surpasses that of Indonesia at 338% and Malaysia at 262%. Closely mirroring the warning signs, the Bangko Sentral ng Pilipinas also reported that non-performing loans in April rose to 3.57%, the highest in 5 months. These are loans that are either unpaid or seriously overdue. A double whammy: consumers are falling deeper into debt and banks may be facing tighter credit risks. The rise in credit card debt is happening amid surging living costs, particularly for basic utilities.
Things that come, every month, that you'll have to pay, which means to say, there might be an impact. Let's say, inflation is becoming a problem when things are getting more expensive. Very hard to manage your finances and pay off things that regularly are billed to you. Being forced to borrow to pay for utilities, or your monthly cell phone bill, phone bill, electricity. 4 times what you earn in a month is quite big. I don't know how people will be able to manage that.
According to Sir Percival Peña Reyes from the Ateneo Center for Economic Research and Development, unless Filipinos have additional sources of income, cutting back on spending may be the only option, which could slow down overall economic growth.
Okay, at some point, they will have to cut down on spending. On a macroeconomic scale, people might have to resort to austerity, which would dampen spending, consumption spending.
But for Emmanuel Leico, chief economist at Credit Rating and Investor Services Philippines, this should not immediately be framed as a crisis. He notes that the Roshi report may have overlooked a critical factor in the Philippine context: overseas remittances, which average $3 to $4 billion monthly.
Credit card receivables, I will be concerned if the non-performing levels or the credit card defaults would really be significant. Right now, they're just saying at about 4%, based on the Credit Card Association of the Philippines. So they're not really raising red flags yet. No, in fact, they're saying that they are even less than 4%. But when they exceed 4%, that is something that would start them moving also or taking action that they have already in their portfolio.
In other words, yes, Filipinos are deeply in debt, but many of them still have the means to pay, thanks to multiple income sources and aggressive collection strategies from card issuers. His call, proceed with caution, but focus on education.
Right now, to sound off an alarm that we are at a critical level, I think that is not timely. But at the same time, that could be a good basis to educate the Filipino borrowers not to exceed your borrowing capacity on a monthly basis.
As of April, lenders have set aside nearly ½ trillion pesos in allowances to protect against credit defaults. Their non-performing loan coverage ratio remains strong at 95.10%, meaning banks are still well cushioned for now. Sujin Kim, Bilyonaryo News Channel.